Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. I hope you had a great 4th of July weekend and all the fireworks and celebration and grilling out and just being a straight up American. It's awesome. Weekly market insights. Markets close quarter strong. They shrug off the weak jobs report. So that's the headline over this past week. Markets notched a solid gain over a shortened trading week as investors cheered ongoing diplomatic efforts in the Middle East. The S&P 500 index rose 1.77%, led by gains in communication services and financials ahead of the holiday weekend. The Nasdaq Composite Index advanced 2.12%. The Dow Jones Industrial Average climbed 1.97%, ending the week at a record high. The MSCI EAFE Index, which tracks developed overseas stock markets, gained 1.81%. So the second quarter of 2026 ends with fireworks. The S&P 500 ended Thursday's session at 7,483.24. Earlier this past week, the S&P 500 closed out June with a 1.1% loss, its first monthly decline since March. Still, it gained 15% in the second quarter and 9.6% in the first half of 2026. On Thursday, U.S. jobs data for June came in mixed. The data showed the U.S. economy added fewer jobs than expected in June, yet the unemployment rate came in lower than forecast. Total non-farm payrolls rose by 57,000 last month, representing the weakest tally since February and a notable miss versus the consensus estimate for a 113,000 increase. Also, May's gain was downwardly revised to 129,000 from an initial 172,000, while April's tally was lowered to 148,000 from 179,000. Nevertheless, the unemployment rate ticked down to 4.2% from 4.3%. The rate had been expected to remain at 4.3%. Communication services was the best performing sector this past week, climbing 4.9%, followed by a 3.7% advance in financials, a 2.8% increase in consumer discretionary, and a 2.1% rise in healthcare. Industrials and materials also rose by more than 1% each, while technology and consumer staples edged higher. Fox had the largest percentage gains in communication services for the week, with its Class A shares jumping 13% and Class B shares rising 10%. A regulatory filing showed the company entered into a $1 billion senior unsecured term loan credit agreement to help fund a portion of the cash consideration for its pending acquisition of Roku. The 2-year term loan facility will be available upon completion of the acquisition, with Fox also able to borrow up to an additional $1 billion, it said. Robinhood Markets led the climb in financials, gaining 14%. The company launched perpetual futures with no expiry date tied to the commodities like gold, silver, and crude oil, as well as exchange-traded funds and currencies in Europe, multiple media outlets reported. Real estate declined 1.5%, while utilities and energy shed 1% each. Digital Realty was among the hardest hit stocks in real estate, falling 10%. The company said on Tuesday that it had priced a secondary public offering of 12.3 million shares by affiliates of Blackstone at $185 each, representing a discount to its Monday closing price of $190.58. So how are we doing? Weekly market insights, Y charts. Thanks for this information. Let's see. The S&P's up, trailing one-year number, about 21.62%. Nasdaq 27.45, MSCI EAFE 21.83, Dow Jones 20.93%. That's a 1-year trailing. Year to date, here we go. Year to date, we're about up 9.98% on the S&P 500, the Nasdaq 11.49, Dow 10.99, MSCI EAFE 10.83. 10-year Treasury notes trading about 4.49%. That is up from 3 months ago at 4.3 print. Let's see, and up about a month ago from 4.46. So that's the 10-year Treasury rate. Mortgage rate, I think today's print was 6.59% for a 30-year fixed. So mortgage rates stay elevated. Let's see, this week, key economic data. Monday, PMI, composite ISM, 3-month T-bill auction. Tuesday, international trade in goods and services, 1-year Treasury bill auction. Wednesday, EIA petroleum status update, 10-year Treasury note auction, and an FOMC minutes are released from the June meeting. Consumer credit also. Thursday, weekly jobless claims. Fed President John Williams of New York and Lori Logan of Dallas, they speak. Existing home sales Fed balance sheet data comes out on that. Notable companies reporting earnings this week are Pepsi on Tuesday. Wednesday, Delta Airlines. Will be kind of listening to that and what the consumer's doing in flight and travel. All right, stay tuned for the next segment. So the head of global research at JP Morgan released their 2026 mid-year outlook. And here's the executive summary. We see 3 core themes shaping the second half of 2026. First, markets will continue to navigate the tension between the ongoing energy supply shock and a resilient growth backdrop supported by improved labor markets and AI-related capital spending. Second, the AI upstream theme remains a key pillar of growth as CapEx cycle broadens. Third, geopolitical fragmentation will persist as a structural source of uncertainty across macro and markets. Against this backdrop, we see a broad realignment of supply chains and trade and capital flows as security resilience considerations increasingly take precedent over costs and global investment decisions. We maintain our view that the global expansion remains on solid footing. Growth is supported by improving business sentiment with the easing of last year's extreme fears of global trade disruptions, alongside a resilient consumer as labor markets improve and a continued surge in AI-driven capital spending. We expect global core inflation to remain sticky, close to its 3% average over 2024-2025, with renewed goods price pressures driven by demand, technology capacity bottlenecks, and energy costs pass through. In the face of the strength in demand and sticky inflation, central banks have turned more hawkish than what we had penciled in at the start of the year. However, we still expect central banks to be patient rather than to rush to tighten policy, and we see global policy rates rising by less than 20 basis points this year. Renewed geopolitical tensions and fresh U.S. import tariffs remain key risks. And U.S. equities remain constructive on the AI-led growth cycle and expect the S&P 500 to approach 7,800 by year-end. We maintain a bullish U.S. dollar view supported by stable growth, market pricing of Fed rate hikes as inflation persists, and a renewed narrative of U.S. exceptionalism. We reiterate our call that the Fed will remain on hold for 2026 and hike in 2027. U.S. Treasury yields are expected to rise modestly, and credit spreads remain either stable or widen marginally across most segments in the second half of 2026. In emerging markets, we maintain a market weight on sovereign and corporate credit. The easing in geopolitical uncertainty should lead to lower oil prices, and we therefore reassess our outlook with Brent prices ending the year at around $78. AI has been a defining theme since the mid-2025s and will remain so in the near term. As investment accelerates to support an AI-enabled economy, issuers are likely to access a broad range of capital markets. We expect continued innovation and financing across the sector. As you navigate global markets, JP Morgan Global Research is looking forward to continuing our partnership in providing investment insights and ideas in 2026 and beyond. Sincerely, Hussein Malik, head of global research at JP Morgan. I agree with all of those views. I think you did that's a great summary. And then they dive into deep detail in the 2026 mid-year outlook, which I find very interesting. So well done on that. Thought that you guys would appreciate the view from one of the largest investment banks in the world, if not the largest. Stay tuned for the next segment. Benefits of a mid-year financial checkup. As a financial professional, I'm always working with my clients to help make certain they're comfortable with their financial goals. Here are a few things that we've been focusing on lately that might be helpful for you too. Goal review. So, setting financial goals and monitoring your progress throughout the year are essential. Investment review. We always review portfolios to help ensure they're aligned with our clients' goals and adjust them as needed. Retirement strategies. We review retirement contributions and make sure our clients know where they stand. Insurance coverage. It's crucial to review insurance policies, consider making adjustments, such as updating coverage or beneficiaries. And estate planning. We highlight the importance of estate strategies and help our clients review their documents to ensure they're up to date. Financial literacy. We provide resources and guidance to help our clients improve their financial literacy so they can make informed decisions about their finances, like budgeting and 529 education savings, and checking to make sure that everybody's on track, and maybe setting some plans for the approach of the end of 2026 tax year. If you need help with any of these areas or have any other financial concerns, we're here to help track your progress towards your financial goals if you allow us, right? Let's work together to pursue financial success. So if you've got questions about it, give us a call, 317-399-1107. Who knows what the GPT in ChatGPT actually stands for? I'm guessing very few people, and that's fine. Most of us just know it is something that's suddenly everywhere. If you're curious, it stands for Generative Pre-trained Transformer. As you know, it creates new content, learns from enormous amounts of text, and understands context rather than just keywords. But the more interesting question isn't what it stands for, it is what to actually make of it and how it will affect our lives. AI is useful for organizing information, finding patterns, and explaining things quickly. It can be a big time saver. What it isn't good at is knowing you, your family, your goals, the trade-offs that matter to you, and the context behind the numbers. That's the part that requires a person. We're not AI experts here at Northbound Wealth, but paying attention to what our clients are hearing, reading, and wondering about is part of the job. If we can help make something feel a little less unfamiliar, that's worth doing. Tell the truth. Did you know what it stood for? Or are you like most of us and you don't care? You just like what it can do. IPOs in the news and what you need to know. With the well-known aerospace company recently making its public market debut, IPOs have been getting a lot of attention lately. It felt like a good moment to share some perspective on how IPO processes actually work, because there's often more to it than the headline suggests. An IPO, or initial public offering, is the moment a privately held company sells shares to the public for the first time. The process runs through investment banks that manage pricing and allocation. The night before a stock begins trading, those banks set a final offering price based on demand for large institutional investors. The part most people do not realize, there are two very different ways to participate in an IPO, and they're not equal. The first is buying shares at the IPO price before the stock ever trades publicly. That access is almost exclusively reserved for large institutional investors. Most individual investors will not receive an allocation at all. The second is buying once shares open on the public markets. At that point, anyone can buy, but the price is no longer fixed. If a company generates strong excitement, its stock may open well above the IPO price. The reverse is also true. Either way, you may be stepping into real volatility from the very first trade, with none of the pricing advantages implied by the headlines. Why the excitement often outpaces the reality. High-profile IPOs tend to attract a great deal of attention precisely because the companies behind them have compelling stories. But it is worth separating the story from the investment mechanics. When a company goes public, the proceeds often go towards satisfying early investors, paying down existing obligations, or funding day-to-day operations, rather than a bold mission that made the company famous in the first place. The narrative and the financials can be two very different things. Newly public companies can also be more volatile than established businesses, particularly in the early weeks of trading. It's difficult to anticipate how a newly listed stock will perform, regardless of how much anticipation surrounds its debut. The bigger picture. Your portfolio is built around a long-term strategy designed for your specific goals, risk tolerance, and time horizon. A disciplined, diversified approach is focused on your financial situation and is not reactive to whatever story is dominating the headlines in any given week. There's also something most investors do not realize. If you hold a diversified portfolio, there is a reasonable chance that you will gain exposure to these companies at some point. For example, SpaceX being included into the NASDAQ. In fact, certain investments are required to purchase newly listed companies because their investment objective is to mirror the stock market or a particular index. So you'll get them by default in some way, a small portion. A diversified portfolio often takes care of this for you. If you have any questions about anything you're seeing in the news or hearing out there, or just simply want to talk through how your current strategy is positioned, please do not hesitate to reach out to us. That's exactly what we're here for at Northbound Wealth Management, 317-399-1107.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.